use. I talk to a lot of clients during, I suppose, the week, and there's a whole variety of different, I suppose, aspects of how we've been affected. Some people have been not too badly affected financially. Some people have been, but one of the things that I suppose comes to light and what is common to all is that we do need to make sure that our money is working for us. And whether that's saving for a mortgage, saving for our kids, saving to pay off loans, it's about putting our money to work and to use. So I'd like to go through that with you this afternoon. So just to talk about this current state of the savings market, I've got just 3 slides here on what the situation looks like. I've started with children's savings. A lot of people who have children try to kind of put monies aside, and the key, I suppose, thing to note from this slide is that the best rate on account at the moment is around 1% per annum. And as a financial advisor and as a parent, I would struggle to, I suppose, comprehend why you'd want to be doing that, certainly not for the next 5, 10, 15 years, particularly given when inflation is likely to be at least that, if not higher. So you're barely keeping in line with inflation, i.e. your money is actually eroding. With regards to adult rates have come down significantly and they're likely to come down even further. So you can see there that Ulster Bank have a rate of currently 0.85%, and it goes down as little to zero 0.1, and many more accounts pay even less than that. If you allow for dirt tax, which is taken annually, which will shave off a third of those rates, really what that's telling us is the bank have become like vaults, where all they're really doing is just housing our money. So they're safe, but there's no return from them. And in my opinion, it is likely that that will be the case, certainly for the next 5 years. The USI have predicted that it's going to take about 6 or 7 years before interest rates start to climb at any reasonable level. If you look at lump sums, so for those people who have a sum of funds in the bank, the rates are actually even worse again. You're seeing there that the rates are down to as high, I suppose, as 1/3 of 1%, which is a 3-year state savings account. Now, this was an account that, believe it or not, about 3 or 4 years ago was paying 10% over that 3-year period. It is now paying 1% over the same period, which really, again, is no return on your savings. I know I come across clients who have money in the credit union, who have money in prize bonds, and with the greatest respect to both the post office and to the credit union, the times of old when they were paying interest rates, they've gone. There is going to be nothing to be earned in the next 3 to 5 years. I'm fairly certain of that. If anything, the banks will start to charge us for holding our money, and it's likely that it'll probably come in towards the back end of this year, particularly for the higher deposit rates. So it's not all doom and gloom. I just want to talk to you about essentially what Alpha Wealth talk to clients about. And it's really, as I said, making your money work for you. How can we offer you savings plans that can do that? Well, this slide that I've thrown up here, which is a scale of risk. And when I talk to clients about risk, they sometimes get a little bit nervy. And all I'd say to you is that we shouldn't be uncomfortable taking risk, but we have to make sure that it's moderated, and we have to make sure that it's appropriate to what position we find ourselves in our financial life cycle. So, for example, when I talk to clients about pension funds, for someone who's in their 30s, I advise them to take a high risk. Why? Because the term that they have until they draw this money down allows them to suffer from these downward cycles that will inevitably happen, but recover back from them. And history has shown us over the last 100+ years that as long as you can give time to something, you will typically be better off in growth assets. And by growth assets, I mean things like shares, by property assets, by alternatives such as gold, oil, and so on. It's interesting. I've been following very closely, I suppose, the area of like cryptocurrency recently. I've penned a couple of articles for some of the recent newspapers. There's one I have that's being published on Sunday in the Independent. And these are very high risk instruments, and they have their place for those cohort of people that are prepared to take that level of risk. It might be a client that has 10, 20,000 euros on deposit, that it's prepared to accept a risk level, which on that scale of 1 to 7 would absolutely be a 7. If there was an 8, cryptocurrencies would fall under that. But that's not really the mainstay of financial planning. For me, it's about having long-term plans which are consistent and which are appropriate to make a decent return. I.e., it's not about trying to chase this pot of gold at the end of the rainbow, because for most of us, we won't find it. So, in essence, what I'm really saying today is that I prefer people to not operate in either of those two extremes. There's no real purpose of having money in a risk profile one account where there's no risk, no reward, i.e., the banks. Certainly not for anything significant. People ask me, well, Nick, how much should I keep, in my current account? Well, it's the bare minimum that you can afford to live on. There's no purpose really of keeping too much. And whilst I accept that we all want to have an emergency fund, if you have an account where you can access it, but at least it's working for you, that to me is the equivalent. On the other side of the scale, taking this level of risk like people have been doing with the likes of GameStop, where a lot of these kind of novice stay-at-home investors are driving up the price of things. They're, as I would consider, akin to these pyramid schemes or these Ponzi schemes. I would say to people, steer well clear of that. So for the vast majority of people, what I want to suggest is that you kind of operate around the risk level 3, 4, and 5, primarily dependent on the amount of money you have, the time scale involved. The longer the time, the higher up the scale you go. And if it helps, and if you say, well, Nick, I don't know what a 3 means versus a 5, basically those numbers that sit above that bar give you a good indication of what the reward is likely to be on a yearly basis, but also the potential risks as well. So, for example, if I come across a saver who doesn't want to take much risk at all, um, therefore, I would suggest to them that being on a risk scale 3, you should expect a return of about 2 to 3%, 2 to 4% per annum. Now, I'm erring on the lower end of that scale because interest rates are at nil, and we have to be cognizant of that. So, whereas before a return of 5% a year would be fairly typical for low to medium risk funds, in this climate of 0% returns, 2 and 3 and 4% a year are actually quite good. The vast majority of you listen today, I would suggest that somewhere in the middle risk profile 4 would be appropriate. What does that mean? It means that you should be looking to achieve about 5% return per annum in this climate, but also accept that you could lose 5% in any given year. Now, I'm not one for advising people to take risks and to lose their money. But obviously, I'm saying to people, well, okay, if you are saving for your child, or if you're saving for a house, and you're saying to me that you've got at least 5 years or even longer until such a time that you're going to need access to that money, well, then you can afford 1 year or even 2 years where it doesn't make that return. And it's about being with the right manager where you feel comfortable with where your money's being placed. I can say to you that I would like you to see Alpha Wealth as an independent broker. We're not tied to any particular company. We have agencies with over 11 companies in the Irish marketplace, ranging from Zurich to Irish Life, Aviva, and so on. So we can absolutely offer you that independence, but also that we are a low-cost company. And one of the things that can eat into returns like nothing else are high fees. My own background is that when I came to Ireland 22 years ago, I started out with the banks. I worked primarily in AIB and I worked my way up. We used to offer, as some of you may remember, these kind of PIPs and PEPs and the SSIA schemes. And they looked really good on paper, but the returns on them were relatively poor because the fees were very high. So what I'm suggesting to people is consider these alternatives to the bank savings accounts because they're not attractive at the moment. My role as a financial advisor, as is David's, is to beat 0% a year. And there is no, I suppose, scenario over a 3, 4, 5+ year period where I feel these accounts won't do that. But again, subject to the fact that you don't overpay fees. Because if you're paying a contribution of say 3 or 4% of what you pay in, and if you're paying a management fee of 1 or 2% a year, that means your fund must make about 5% for you to break even. You're on a hiding to nothing before you begin. So it's about being aware of where your funds are invested, and it's about being aware of what fees you're paying. And I'd like to suggest that Alpha Wealth, as a regulated company, are very transparent. And for any people that would like information, we provide a 2 or 3 page letter of recommendation detailing what we're recommending, the reasons why, and the fees that are associated. And again, it's all laid out without any obligation. So just to kind of go on to, I suppose, one aspect of what I want to talk about today, which was child savings. There's relative estimates of what it costs, the annual costs of, putting a child through kind of primary, secondary, and private school or third level education. And it can add up. Typically, it's expected that to put a child through third level education from fruition, it's probably somewhere between 20 and 30,000 a year. The issue, as I've said, are that we are in this very, very low rate, arguably negative interest rate environment, which is likely to continue. And it's been going on for a long time now. This is not a new phenomena. It's just because it's affected us more than it would have in recent times, because of the fact that I suppose banks have reacted by slashing rates so heavily. The key thing I suppose I want to make is that by making monthly payments, it allows you, over a longer period, it allows you to build up the funds that are required. Now, we've used an example there of 140 euros a month, and I've given you an illustration through one of the insurance companies, Zurich, that I'm going to focus on today, because I feel that in this space of regular savings, they are the best of their type. You can see there that even saving 140 euros a month, which was the old child allowance, I appreciate it's gone up to 145 now. After 5 years, you can build up a fund of about 10,000 euros. So it's a nice way of, building up a nice fund over a longer period by way of relatively moderate payments. So I'm just going to get into the nub of the specifics of what I'd like to kind of mention today, which is that whether you're saving for your child, whether you're saving for your grandchild, whether you're saving for a house, a car, whenever we can go back on foreign holidays, if you want to try and build up a little bit more of a fund to go on a slightly nicer holiday, Zurich offer a plan called the Easy Access Saver. It allows lump sum investments. So some people may want to start with a contribution or maybe add to that further. So, for example, I have 3 children. My oldest is 15 and my youngest is 9. If I was starting this plan, and I started it a while back, but if I was starting it today, I might start with a lump sum if I have it, say, sit in the credit union, and I may want to then add further to it. And this product allows that. The reason why I like this particular plan, as the name suggests, is that it's totally accessible. You can get your hands on it after 6 months, after 6 years, or after 16 years. There is no specific time frame, and it's available within 5 working days. So again, it doesn't have to be tied up. So I talk to a lot of people who say, well, they don't need access to this money. Nick, you're saying that we should save for the long time. Yeah, I am, but isn't it nice to be able to take the money out if you feel it's not doing what you expect, or if you want to put it back into the banks at a later stage when the banks do start paying interest? That is your obligation. Zurich provide online access for those who want to look at it. They're a broker-only company, so you have to operate through a brokerage, and this is not unique to Alpha Wealth. Some of you may have started a savings plan already with one of the insurance companies and say, well, I'm sorted. And my argument and response to that would be, well, okay, but are you comfortable that you're paying the lowest fees? Are you comfortable that you're invested in the right funds for you? And we provide analysis and say, well, okay, let's see what your fund has performed at. Let's see what it would have done if the fees had been lower, and maybe if you had been in a more appropriate fund. And we provide that analysis for clients, not because we're trying to get everyone to sign up to this savings plan. Our fee, respectfully, is relatively low, and it's certainly not going to pay our bills if we just sell savings plans all day long. But what it does is it just lends itself well to giving people a real return on their money. And that's the most important aspect of why we are suggesting that people do review this. I won't dwell too much on this, guys, but again, this is about, the costs of, education savings. And to be honest with you, like, it may transpire that, your child or your grandchild may work a little bit through their college years and maybe fund themselves. I know I had to, but it might be to help them get a rung up on the ladder. It might be just for themselves even. I mean, some of you may have older children where you might say, Nick, well, this is a little bit too late for them. All I'd say to you all is that it's never too late to save. We should be saving, whether we, can afford to or not. That's a different story. And our role, myself and David, is to help people save money in other areas, such as on their health insurance plan or their home insurance or their life insurance, to give them the affordability to do this. Um, Mortgage rates. We talk to clients about trying to save money on their mortgage. And again, I've just thrown up a slide there around some of the rates that are out there. The bank rates have come down significantly over the last while. So for those people that say have a mortgage, again, it lends itself well to say, okay, well, maybe I'll have a review of my mortgage plan and see, can I save myself some money? And maybe that will provide more capacity for me then to save. And this is really the role around financial advisors. It's funny, I often get asked, like, am I like Owen McGee? And if Owen ever hears this video, Owen knows me. I actually worked with him in Ulster Bank. And I'm delighted that Owen, is on TV, because what he's done is he's actually helped financial brokers like me, because he's basically made it more, I suppose, aware for people that they should be reviewing their finances and they should be questioning, what fees they're paying, and be a little bit more, I suppose, astute. And to be honest with you, the pandemic has caused more people to do that. We're busier than ever because people are starting to review their own scenario. We are offering 30-minute complimentary financial reviews for people, just to look at whatever aspect of personal finance they wish to look at, whether that's their mortgage. We don't sell mortgages, by the way. We just give advice, whether it's the area of insurances. And I say to clients, the best way to test alpha wealth is whatever plan that you currently have, whether it's in savings, whether it's your pension, whether it's in your your life insurance or your house insurance, send it on to us. We have a look at it for you. We put it down on a spreadsheet and we give you advice and guidance on that. And whether there's anything in it for alpha wealth or not, I'm not particularly fixated about. I had a conversation before this webinar with a client on, the mortgage that they had. And, we looked up different rates and I gave them advice about what I would do. It's actually interesting. These are the rates that we discussed and I put them up on a slide. Advent, what a great institution to come into the Irish marketplace. However, Advent won't lend to everyone. You have to be permanent in your job for 2 years. You have to be in a certain area of the country. They only lend typically to the cities, not unfortunately for those that live more remotely. But it's kind of set the benchmark then for what people should look to aspire to. And what I say to people is you should know what rate of interest you're paying on your mortgage. And if it is over 2.5%, then you should ask yourself, can I do better for myself? Because there should be an opportunity for you. If you're fixed, it may or may not pay you to break your fixed term. And if you're on a tracker, you're not going to touch it typically. But if you're in that area in between, or the next time you are due for renewal on your fixed rate, that's when you should be looking at this in a more concerted way. And respectfully, ignorance is not bliss. I don't condone the fact that people are too busy or they just don't know. Talk to someone like us. We'll make it very easy for you with no hassle. I have a lot of engagement with clients over email. People email me 9 o'clock at night when they're available, and I send a response to them. It doesn't take me long and it doesn't cost me anything. And it's just about giving people straightforward advice. So just to maybe go through a little bit more around the savings plan. And again, this is more geared towards child savings, but it's not just for children saving. It's just Zurich could put a little bit of a spin on this because obviously it's a very, I suppose, captive market. But for those of you that don't have children, it's equally applicable. It's the same plan. It's just branded slightly differently. We talk about, why people should put their money into these kind of growth type instruments. Let Zurich manage your money. Zurich are a really good manager. And people have said to me recently, oh, Nick, yeah, look at what's going on in the market. Oh, I think there's going to be a recession and I think markets are going to fall back. And I say to them with the greatest respect, please tell me something that Zurich don't already know. If you think the markets are going to fall, why would you assume that it's not priced into the markets at the moment? Zurich behaved impeccably, in my opinion, during the COVID crisis. They were very proactive in talking to financial brokers like me about their approach. I've put up a schedule here on a fund called Prisma 4, and you can see here on the top of this their performance in 2020 on a fund that is in that medium risk category, which I showed you earlier, we would expect about 5% a year from. Um, and they made 6.9%. And this is in a year of a pandemic. It's phenomenal. And I have some clients saying to me, oh, yeah, Nick, but everyone else did that as well. Well, I can tell you categorically that they didn't. Their next best competitor in 2020 was about 3.5% in the same risk category. They basically doubled their performance. And again, I say this to you without bias. And I'm not saying that Zurich will always be the best, but I reference this against kind of like the Premier League. You know, Zurich are the Man City and the Liverpools, and I have no interest really in dealing with anyone below that. With again with the greatest respect, I'm an Arsenal fan, by the way, so I think I'm allowed to say that. Um, with regards to the compounding and cumulative effect of returns, even earning 3, 4, 5% a year over a period of a long time is really significant. And I suppose this is the point that I'd like to make, that it's a cumulative compounding. And that's what Einstein spoke about, this effect of, compounding interest being a really powerful force, one of the wonders of the world. He was right. If you get a return on your money over a long period, it will significantly provide a much better return than even a lump sum of a much greater value. So I just want to kind of finish off by showing you the performance of Zurich versus their peers. These funds, and I don't want to get too bogged down by the phraseology, but Prisma 5 is obviously a risk category 5 fund typically. Prisma 4, the medium risk fund. These are funds that we've extensively used when talking to clients about their pensions, about their savings. And these are really well diversified funds. I should have showed you here. Currently, the Prisma 4 fund is about 57% in equities. And some people sometimes say, Nick, are you telling me to save my son or my daughter's education fund where there's 57% going in shares? Yeah, absolutely. Zurich will invest in over 100 companies, the largest one being Apple because it's the largest company, and they will manage that. And they're buying these stay-at-home stocks that they believe that there's growth in, and they move to more value stocks, the likes of Coca-Cola's and that have lagged when they feel the opportunity is right, and they're really good at doing that. So as I said, this particular savings plan, you can start at a minimum of 75 euros a month. It's completely flexible. You can pay more in or less at any given time. It will beat any bank or credit union, in my opinion, over the next 5 years, undoubted. And again, it's a way of you siphoning money, and it's kind of like a forced saving. Whilst you can access it, whilst you can stop it, it's nice to take money out of your bank account. It's kind of like I ask people to kind of consider what they're spending their money on, and I would see this as a cost, because if you can do, say, even 100 euros a month, that's obviously 1,200 a year. That's 6,000 over 5 years, and then when you have that interest rate cumulative effect on it, it's really, really powerful. So as I said, I've kind of covered off the mainstay of what I wanted to say. I've touched upon one or two other areas, such as mortgage advice, independent protection reviews, pension advice. We help people who have pension schemes through their employers. And you might say, Nick, well, how is that relevant to what you spoke about today? Well, again, we're back to the whole thing about funds and where funds are invested. Are you in too low a risk fund? Is it too high? Do you know what your pension fund is likely to be worth when you reach your nominal retirement age? Do you even know what that is? Are you aspiring to try and retire at 60 or 65? And whilst some of you might say, well, I don't really know, it's good to have a roadmap and say, okay, well, I know I'm 47 and I'm planning between 60 and 65 to exit. And I have a target in mind of what I'd like that to be. And it's not that I want to stop working. I might continue to work. It's about knowing that I financially will be in a position where I could, and knowing what that would mean. This whole notion of like putting your feet up one day, I'm not convinced that that kind of applies. So as I said, it's more about just giving general advice. As I said, David and myself were available. We will be doing more of these webinars. I have another webinar coming up on the 19th of March. David will be doing further ones himself. The one on the 19th is actually about how to become mortgage free. And I'll be touching upon areas in which you can try and improve your financial wealth and try and get to that point quicker. I should have said at the start, guys, but I'm happy to take questions. I'm exactly at the point of which I said I would finish. If anyone would like to ask me any questions, feel free to unmute your microphone and ask me. If you would like to either email David and myself, obviously, or indeed, if you'd like to have the 30-minute complimentary review, please don't hesitate to. I'm conscious, I know that there's a few existing clients who are on this call, many of which may have already set up this savings plan. And again, we're happy to kind of go through that, what I've discussed today with you in more detail. But hopefully you've got a good sense of why we feel very strongly about saving, why we feel that it makes sense to look to the insurance companies, why on a low cost basis, Zurich are the company of choice, and their funds we believe are the most appropriate for this type of vehicle. Is that okay? So if no one has any questions, I will say thank you to you all. I hope you have a nice weekend. As I said, we're more than happy to go through any aspect of this with you.